Hello and welcome to IG's Trading the Markets podcast. And today I'm speaking with Chris Capre, who is a day trader and a swing trader in forex, stocks, commodities, options, and indices. And he's from Second Skies Forex. Chris, great to have you on the podcast. Let's just start with your sort of journey into the markets, because you didn't come from a conventional economics and finance background. What really got you interested in the markets and how did you become a trader?
Yeah, so I had zero training in finance or economics in college. In fact, I never even took one business class in college. I was doing a dual major in neuroscience and philosophy, Asian philosophy. And after I graduated, I didn't really want to go into working in a lab in neuroscience. It just didn't excite me as much at that time. And, so I kind of, just took some odd jobs. I worked in restaurants for a little bit. But, as I started to teach yoga and got really serious into yoga and meditation, I realized that, I have a lot of things that I want to do in my life that are going to require certain financial means. And I'm probably not going to get there as a yoga teacher. And so I started to look for alternative ways to get involved in, the markets and investing. And so I started, trading stock markets and mutual funds, but it wasn't quite grabbing me at that time period. And I had a private client who was retired, very wealthy radiologist who had actually invented some of the original radiology scans for Kodak that Kodak used into their technology. And he was reading a book and he comes up to me one day at his house. I become friends with him and he's like, hey, I was reading this book and I had a really weird feeling that you should read this book. And, I'd never had anybody ever come up to me before and say, hey, I've read a book and I feel like you have to read this book.
Mhm.
And the book was about someone who had just graduated college, not very different from me, who was an athlete, also not very different from me. And, but didn't realize that he wasn't going to become a professional athlete. And he gets a strange opportunity to start trading, particularly trading Forex in Asia, in Japan. And he goes through this crazy journey. And so I took the book and I read it and it got me really excited. And so at that time, you're talking 2001, 2000, 2001. So retail Forex trading was very new at that time. You're talking only a handful of brokers and about 6 websites. So just imagine only 6 websites on the planet about Forex trading compared to the millions we have today.
Mm.
And so, after reading the book, I felt like, yeah, I want to check out this Forex trading. So I had to go to my local Borders and get, stocks and commodities magazines and read about it. And there was an advertisement for a free Forex trading account, demo account with GFT, who's, they since dissolved many years ago. And so I had downloaded the demo account. And the moment I had loaded up the platform, I just had this overwhelming feeling like, hey, this. And I didn't
Mm.
have any training in Forex. I had no classes, read no books on it. But yet I looked at the platform and I felt like I understood what was going on. Like I didn't need somebody to walk me through the platform. I just knew how to use the platform. And when I was looking at the charts, I was like, okay, I know what this currency pair is. I know what this is. And I was able to, start playing with it. So I demo traded for a month and I felt like, yeah, I want to do this. And so I put $3,000 into an account. And 6 months later, that account was $83,000. And so
Wow.
I kind of had a very strange start. And, part of the reason why it went from 3 to 83 was not necessarily some major skill on my part. It was not knowing risk management,
Mm.
and being completely fearless and very simple. I was simple with my technical analysis and I was completely fearless with my trades. And because I wasn't lacking any confidence or I wasn't experiencing any fear around it, I just, went for it. And, trading
Yeah.
standard lots on a $3,000 account is a really bad idea. I do not recommend it to anybody. But I didn't know any different at that time. And there was nobody else out there to teach me what to do. So I had an incredible run and then I hit a wall. And, I literally lost $50,000 in a month. So it took me 6 months to go from 3 to 83,000. And then I lost 50,000 in a month. And that was, a big wake up call that, okay, I really need to start training and, getting to know this market better and understanding it. And so, yeah, a very unusual beginning for sure.
Yeah, I was wondering actually, I mean, you wouldn't necessarily put together yoga with trading necessarily. And I'm
Mm.
wondering how sort of some of the principles that you learned in yoga might help you as a trader, because a lot of being a good trader comes down to trader psychology, doesn't it? And it's not getting too caught up with the emotions. You said you didn't have much fear at the beginning. Greed is an emotion that can impact traders a lot as well. So, how does your practice of yoga help you as a trader?
Yeah, that was actually a big boon. I didn't know it at the time, but it really helped because so I had been, by the time I started trading, I had been doing yoga for several years at that point. I was authorized to be a yoga and meditation instructor. So I completed about 2,000 hours of training by the time I started trading. And some of the things that were most important about it was really being able to focus in the moment. Yoga, a lot of people think when they think of yoga, they think about people doing all these flexible poses. But if yoga was really just about flexibility, then people in the circus would be the best yoga practitioners. And that's not entirely the case, though. You have to be incredibly present with your body when you're doing yoga. You have to be very in the moment. And you have to be incredibly focused on what you're doing because if you're doing some, crazy balancing pose on one foot while holding like your other leg up in the air, if you're distracted, you are not going to be able to maintain that yoga pose. And so some of the most important things from yoga that helped were being able to be really present in the moment, being able also to trust my feeling and intuition, which is something that I think you don't hear about in trading. And, literally before I would trade every single day, I only traded four pairs. It was the four majors. I traded dollar Swiss, which used to actually move back in the day. I traded dollar yen, I traded pound dollar and euro dollar, and that was it. And I had those four charts up. And after looking at all the charts and coming up with my trade ideas, I would literally close my eyes and then I would just feel my body and feel my mind and be like, okay, which one stands out the most to me? Which one is the one that I want to trade the most? And whichever one stood out was the pair that I traded. So the ability to have both analytical skill, which is a mental thing, but then also this kind of intuitive side of trading, was tapping into my gut feel. That was really helpful. And then also being able to just keep my breath and slow my breath down. So by being able to if you slow your breath, you're able to manage your emotions better and your mindset better. You're never going to be in a state of like anger or revenge trading and your breath is going to be really slow. Those two physiological things just don't go together. So
Yeah.
yeah, those were some of the things that I really used to help balance out my trading.
So you started just with a few simple forex pairs. Now you've expanded into stocks, commodities, options, indices. I wanted to talk about the markets this year because obviously we've seen
Yeah.
some really extreme volatility, and then it turned out to be the shortest bear market in history, according to
Mhm.
some. And we've had this incredible recovery. I mean, how have you managed all that? How have you found this year in terms of your performance?
Volatility for me is a boon. So, if you look at, I generally do better actually. The more volatile the markets, the better I do because I'm more of a momentum trader. I'm trying to trade high momentum moves, and volatility offers that opportunity. So, for me, if you look at the FX markets, because all the central banks have brought yields down virtually 0%, which was not how it was in the first, decade of this millennium. There were wide differentials in yields between Kiwi dollar and US and pound and US. You're talking sometimes 3, 4, 5, 6% differential. Now you cannot find a 5 or 6% yield differential unless you start going out to exotics or EM currencies. So volatility in FX collapsed going into the coronavirus. And then now we have an exogenous event that is outside of an economic event. Coronavirus initially was not an economic issue, it was a health issue, a biological issue. And that alone is going to create a lot of volatility because we haven't had an epidemic like this in over 100 years since the Spanish flu. So once the volatility happened, that was fantastic for me because it just meant that when things are moving, they're just moving farther than they usually do. And so for me, in the beginning, I was initially concentrated in FX because some of the best moves were happening in the Euro EM pairs like Euro Mex, Euro Ruble, Euro ZAR. A lot of them hit all-time highs. So that's where it was initially concentrated. And then when the volatility started to slow down in FX, then I started to shift more towards stocks and options. So yeah, it's been an exceptional year and the fastest recovery in history. I think we can all look at that honestly and say, hey, this is most likely the Fed coming in saying, hey, we'll do whatever it takes to not
Yeah.
let this market collapse. And you have to think about, why would they work so hard to make sure the market wouldn't collapse? Because if the underlying economy is strong, it should be able to take a hit. But if the underlying economy is not strong, then you would be worried about it. So you have, the fastest 20% sell-off in history, the fastest 30% sell-off in history, followed by the Fed coming in mid-March saying, hey, we're going to do whatever it takes. And all of a sudden the market rebounds. Now, as to the rebound, I don't think you can ascribe it all to the Fed. I think you have to look at, hey, a lot of hedge funds were not participating in this. Warren Buffett famously said, hey, I don't see anything right now. He wasn't like that in '08. He was saying, hey, I see banks, I see certain companies I'm going to get involved in. But this time he said, whoa, I don't understand this and I'm going to step back. And hedge funds did the same. So that created kind of a liquidity problem. And you've seen the liquidity in the markets, because a lot of the hedge funds and institutions didn't capture most of this rally. You didn't have large players propping up this rally. So it's almost become a retail traders market, particularly in stocks. And so with low liquidity, and then you have all these retail traders that are now home, they don't have jobs, they have these stimulus checks. They're feeling like, hey, I want to start trading the stock market. And so, if you were day trading the stock market, you look at certain stocks, you're not going to see a lot of single share, double share prints, like shares on the time and sales coming in at like 1, 2, 3. That's like the smallest retail trader possible. But now, since the coronavirus hit, you're seeing a lot of time and sales, looking at the level 2, and you're just seeing a lot of single and double share prints. And that tells me that liquidity isn't there. And so, particularly in the stock market and the nano, micro, and small cap, the retail traders, the Robinhood traders, they've been dominating. And if the institutional players aren't there, then the retail traders are going to push the market around, and you'll see that.
What does that mean about this rally? Does it mean that if it's not supported by those institutions, that it doesn't have that much more room to run?
I would have thought that, but then the hedge funds finally started realizing they have missed so much of it that they've actually started to come back in the last couple of weeks. And so you're seeing kind of a lot of chatter about, hedge funds saying like, look, we're going to start buying dips basically, because if they feel that this market is going to continue to run and they've missed part of the rally and it rallied without them, then what can the market do with them? So I think if they decided to sit out for the next 3 months, then I think you would see trouble with this rally, which is definitely overextended in my opinion. But they are now stepping in the last few weeks, which means that dips are going to be bought, and they're going to be looking for, they're going to stay away from the nano, micro, and small cap, but they're going to be looking for, value stocks. They're going to look for growth stocks, momentum stocks.
It's a tricky one, because on the one side, you're saying the rally looks overextended. On the other
Yes,
side, you're saying there's a lot of uninvested capital from the
correct.
heavy hitters like the hedge funds.
Yes.
Which side is going to win? Which is going to tip the balance?
I think what's going to happen is that if we were to get a second coronavirus wave, then I think we're going to see how well this market is propped up or not propped up. Because if you look at how fast it sold off, it lost 20% in the fastest 20% drop in history, the fastest 30% drop in history. And that just goes to show you that the market actually wasn't as strong as people thought it was. If you look at the S&P 500, only 1/3 of the companies were actually investing in R&D. The other 2/3 were just buying back shares, which if you think about that, that's kind of a very low IQ move for a company. Amazon's not going to spend a lot of money buying back shares. They're going to spend their money reinvesting in their technology, refining the process. They run 150 experiments a day on all their processes. That's why they are the most valuable company out there. That's why they're constantly increasing margin, because they're investing their money in R&D. But 2/3 of the S&P companies aren't. So they're just buying back their shares. And if they were just buying back their shares, well, then doesn't that create an overvaluation in stock prices? Yeah, I think it does. And so when the market started to sell off and they were no longer buying back shares, you got to see that the last bull run before the coronavirus sell-off wasn't as strong as people thought it was, because once the buyback stops, what happens? The market sells off. And so I think there's definitely a very strong possibility that a second wave of coronavirus and, come September, like when we start to see how many people are still unemployed in the US, you're talking 15, 20, 30 million people are still unemployed, and certain jobs just aren't coming back. Service sector is not going to come back with any sort of vigor. Airlines are not going to come back with any sort of vigor. Who wants to travel right now? So I think it is very vulnerable right now. And I think it'll only take one event to realize how vulnerable it is. I mean, the NASDAQ is something like 23% of the NASDAQ right now is 5 companies. So it's not broad based, it's just the FAAMG companies. So I think, all it's going to take is one more serious event, and then we're going to lose a lot of these gains.
Yeah, it doesn't sound very stable. Anyway, Chris, thank you so much for your time today on our podcast, IG Trading the Markets.
It was a pleasure.
That was Chris Capre from the Second Skies Forex. I'm Victoria Scholar, and don't forget to subscribe.
For more videos like these, subscribe to our YouTube channel, IG UK, and make sure to follow us on Twitter. We're at IGTV.